everybody. Welcome to Friday, another Talk Money with Tom show. We're coming live from Silicon Valley. We are here to help you with your questions about retirement, whether you're looking forward to it or already in it. We can help you out here. You want to be able to send in your questions. Send them into Ask Tom with talkmoneywithtom.com. You can do that right now. We'll get them live and try to answer them. Send them during the week. We'll get some time to take a look at them. You can go into the chat and put the questions in the chat if you'd like also. Go ahead and start doing that. We'd love to see, these questions come in live so we can try to answer them. And of course, we've created this whole channel on YouTube really as an educational resource. And there's over 1,200 videos on here now. You can subscribe to that channel and push the bell button to get notified when we put something new out. And the reason we did this is we feel like there isn't a lot of education in this area that's out there. This is a great way to maybe, start to learn more and more about retirement. We feel that the more you know about retirement planning, how to manage your money, and tax planning, the better your retirement can be, at least financially. And so that's why we're here. This is something we do, for you to try to get someplace with your retirement. And then, of course, if you want to, you can just meet with us. We have an appointment calendar that's live. You can go to our website, the link here on the channel. Book appointment button looks just like that on the corner, and pick out a 30-minute time to meet with Ethan and I, and face-to-face, phone, video, whatever works for you. We can try to answer your questions, kind of one-on-one. So look forward to that. So obviously, we start every show off with a summary of kind of what we saw happening in the market this week. And it's been a really kind of exciting time to be an investor the last few weeks. And I'll use this view here to start with so you can kind of see what's happening. A little bit of a different chart to start off the summary with. I usually start off with the S&P 500, which we'll get to, but this just shows the rate of return by week going back to, looks like, late 2021. And really, it's kind of when the market peaked out. We had a great run for 20 and 2021. Then they started talking about, raising interest rates, and we started to see, some of these negative bars come in 2022. But the last 3 weeks is pretty unprecedented in this time frame. If you look, we had nearly a 6% return 3 weeks ago. And really, over the last 3 weeks, as we sit here, roughly about a little over 9% return in 3 week period. Now, you have to put that into context. If you look, there was a couple of down bars 2 weeks in a row that came just before this. But also, the S&P 500 averages 11% a year over the long term. So having a 9% return is a spectacular thing. And I really operate under the concept of momentum, which is this, that once a body is in motion, it tends to stay in motion. And there's some friction here, and it'll eventually slow down and what have you. But, we have had a phenomenal run here that's probably not going to disappear tomorrow.
Yeah, you can just look at that magnitude of those bars, too. They're bigger. Like that week is just that massive compared to everything else.
Yeah, it was stunning to me. I just thought that was the most incredible thing. And it's not super surprising in the sense that, at that time, there were so many people saying the market was going to go much lower, so much short interest. I don't know if you remember, we had that survey from the bull bears from Bank of America, and very pessimistic, right? I mean, it was way over into everybody thinking the market's going to go down. And these are, a survey of professional investors. And so when you see that, often you'll see the other direction, mainly because, again, people are shorting the market, thinking it's going to go down, and then they have to cover those shorts. And when they cover shorts, they buy them back, and it creates an up run, and you kind of get this panic, buying. So I think that's really interesting. And then if we look at kind of the S&P 500 here, you can see it's a pretty incredible looking, tail there that's happened at the end. So this goes, the very peak on this chart was back in January 3rd of 2022. So very beginning of the year, all-time high for the S&P 500. And, we hit a low last year, October 13th on the S&P 500. And we've been kind of crawling up until July. And then we had a 10% drop from July to the end of October. And now we've had this big jump. And so we've managed to accomplish some things here. We've turned the boat from negative, primary direction to positive. We've managed to maintain that positive direction with this move here that's happening. And even in this little trend here, so we had a little downtrend with three highs that were all lower. So the danger was we were starting to establish a new overall downtrend, and that was a real issue that could be happening. But obviously, we broke through that. We then established a new high that was higher than a previous high, which we hadn't done, since July. So that's good. And as of today, as we're sitting right now, the market hasn't closed yet. Maybe it has. It actually. Well,
No.
by the time the show's over, it'll be closed. And we've exceeded the high, the second high there. So we might close above that. And if we had a checklist of wishes and desires, love to see it get above the high that was established for this year, which was the end of July. Specifically to see that before the end of the year, get a new high. We're within striking distance. I wouldn't be surprised to see that happen just because there's so much momentum here. I also wouldn't be surprised to see the market take a rest here.
Yeah.
And I've been saying that actually for about 4 days, and it hasn't happened. It keeps, even if down a little bit during the day, it'll end up by the end. Not a lot. The pace of change has definitely slowed down. There's a couple divergences on my charts where, the new highs that we're getting, we're not seeing the same highs on some of those indicators. And then we're also seeing, a stretch where the RSI is hitting up against 70, right? Which gets above 70 on the RSI 14-day basis. Oftentimes you'll see some pullback. Below 30, you'll see some run-ups, which is exactly where it got to. I think it got about to 828 on a close basis at that bottom.
Yeah, a lot of technical traders start to take their profits when they see these divergences.
Yeah, see divergences, see stretch. And so I wouldn't be surprised to see, we're not going to go, in my opinion, we're not going to go straight through to the all-time high for the year, right? Or for the whole market for that matter. There'll be lots of bumps and, turbulence along the way. But a lot of this has to do with some very fundamental pieces, and we'll show some other pieces here too. But where inflation is getting better, and the Federal Reserve has last rate increase was July. Yeah. The last meeting sounded like they were looking at the possibility of not having more rate increases, at least a little.
Yeah, and Watch Tool has now gone to 100% for no raises in December and January.
Yeah, so this is a pretty cool tool that comes out. It shows the futures market for what the expectation is for what the Federal Reserve is going to do. And neither one of us has seen it at 100% before, up into 99 point something. So it's actually at 100% probability that we will not have a rate increase at the next two meetings. And so the meeting, December and January, then there's nothing in February. The next meeting will be March. And actually the tool right now shows a decrease in rates by May. Would be the projection. Now, the Federal Reserve is a group of humans. They're going to decide what they want to do. Handicapping what they might do is difficult at best. Although I will say that CME tool has been a little bit more accurate as to what's actually happened than what the Fed has said is going to happen or projected that was going to happen. So we'll see how that plays out. But the last thing on the checklist, of course, would be to get to this new all-time high. I would be very surprised to see that happen this year. Just not enough time left this year. But we're not that far from it. I think that's like 5% above where we are now. So it's possible. But what happens is you get to these highs, like right now where we were a high, those become kind of resistance points. And it takes a little while to get through those, maybe a backup. And this is assuming it's going to continue upward. It doesn't normally go, if you look closely, on a straight line for very long, right? There's generally some profit taking. There's a lot of people that are in the market for short periods. We're not one of those per se, but looking at it by day. So of course, this is a great chart. This is the fund management survey. So just in this month, this shows how much overweight or underweight the fund managers are based on this survey compared to their targets for how much should be in stock. So when you see that blue blob above that line, that means they're overweight. They're, so if they're at 60% is their target, maybe they're at 65 or 70 or whatever. And the blue blob below that means they're underweight. And you can see that they've been underweight here from 22, 23, pretty substantially. So they finally just went to just slightly overweight, right? Maybe more or less back to where their, target weight is. If you look closely at this chart, you'll notice that every time it's gone from underweight to overweight, it's gone overweight quite a bit. I mean, it's kind of, there's a lot more blob on the top of that line. And so there's some more money potentially on the table that can come in from big sources. We're seeing similar things, in terms of money on the sidelines with retail investors, other institutional investors, because this is fund managers, there's pension managers, and all these things. And so, I think this shows some power. It shows why we're seeing these gains because that money's coming in. Right? These are the ones that move the market. The retail investor, interestingly enough, never used to really, they call them the small lot or odd lot investors or what have you in the day, way back. They never used to have that much impact on the market. It was always focused on the institutional investors, of all types, because that's where the big money was. And that's still true. But in 2020 and beyond now, we are seeing the retail investors have some more impact because they're using options. And so they're able to take a dollar amount and magnify their impact on that stock by using an option. Now, it's a pretty crazy way of investing. You can make a lot, lose a lot, but nonetheless, we are seeing some more impact from that group now than we used to, which I think is a good thing because you need, the institutional investors are always kind of locked into the past. They're all looking at, what happened in the 70s, and, we all know the history. And sometimes people that just need, they just like the artificial intelligence or whatever it is, the clean energy, and they want to, ride that wave, and they create that wave in some sense too. So now this is kind of interesting here. One of the things that we've been talking about this a little bit over time is that the bond market was not participating in this rally all year. We had a little run up at the beginning of the year, and it gave it all back, and then we sold off. And I just read an article saying that non-U.S. holders of treasuries in September sold a net of $1.7 billion worth of treasuries, mainly China and Japan. And so if you look at like September, October, pretty bad months for the bond market.
Yeah, they missed out though on that rally.
They sure did. But they're probably doing it for other purposes. There's all kinds of things politically, whatever it might be. And so now we're seeing a nice rally. Yeah. And if you look at this chart, this is from Morningstar. It just shows last year what they expected in total return per year over a 30-year period out of different categories versus this year, 2023, which is in the blue. And most of them are pretty similar, but they are projecting the biggest difference on this chart is the projection for higher rates of return from bonds.
Yeah.
And we've certainly seen that. If you have some long-dated bonds in this last several weeks, you're probably up a lot on those too, just because they had sold off so much in September and October. But they're projecting that value is going to outdo growth. I've been seeing that projection for years and years. It has not worked out to be true, but this is over the next 30 years. Yeah. So that's a different look than, hey, the next couple of years. But I think that's kind of fascinating. I think it's just something to watch for. We're reading lots of articles that the big hedge funds and what have you are really playing in the long bond market arena because that's where they feel the returns are coming from. So it's something to look for. And we moved into some long treasury bonds, some of our portfolios, 3-4 weeks ago. And
yeah, I've been seeing articles about hedge funds getting to long-term municipal bonds that have been kind of oversold by the individual investor.
Yep.
They're seeing an opportunity.
Yeah. Yeah, the irony with bonds is that the people that own them, even for us, they're the safe haven, they're the safe asset, and that to watch them deteriorate, you've got a group of people that are, less accepting of risk. Mm-hmm. And so when it starts to deteriorate, they're more likely to sell. And so you got the foreign selling going on, you got the Treasury and the Fed, basically dumping bonds. Also, the Treasury selling to basically get money to pay the deficit. The Fed is trying to get them off of their balance sheet that they accumulated. There's a whole lot of sellers out there. So you got panic, bond, risk-averse people, and structural issues within the government, and then the non-U.S. governments too. So a lot of headwinds for bonds, but a lot of those are kind of structurally, taking care of themselves slowly but surely. And I would pay attention to the bond market personally. I think there'll be something there. And if you have bonds and you've been worried about them, they're doing a lot better now. And they're really kind of right on track to where they were prior to the pandemic in terms of if you look at the Vanguard Total Bond Market Index. So I think it's just something to watch. Now, of course, one of the big things that happened, start with this. One of the things that's very interesting about this chart, it shows the interest rates on U.S. Bond debt, and Basically, you can see going back to 2008 here, we've had a phenomenal lowering of interest rates all the way through up until 2022, the very beginning of 2022. And it's a pretty dramatic increase, right? Looking at that chart, that's a long period of time, right? From 2008 to 2023. And this is what's causing so much trouble with the market. And this is why everybody thinks we're going to have a recession, because you can't have that type of interest rate change historically without recession.
Yeah, because a lot of companies keep refinancing their debt because the interest rates kept going lower, so they just never worried about it.
Right. Yeah, exactly. And so, however, when I look at this chart, one thing I see is, first of all, we're at, almost 5.5%. That's pretty much an average, right? I mean, yeah, it's been a big jump back up, but we've been higher than that before. Some of those markets were fantastic. 2009 was the bottom of the 2008 downturn. We had great runs really all the way through in this time period from 2008 to 2020, end of 21. Other than the pandemic, that big 35% drop, which we recovered from very quickly thanks to all this government money that came out, that was a phenomenal run time frame. But rates were coming down, so we'll see what happens here. It's something to watch for. And of course, here's what they're trying to do, which is lower the inflation. Mm-hmm. So this is the consumer price index. There's two big baskets that the Fed, talks about: consumer price index, and they really favor PCE, personal consumption expenditure price index. But this is what was reported this week on Tuesday. And the market jumped really hard on Tuesday. Actually, it was a green shirt day. And what you can see here is that it kind of peaked out, and this is total top line inflation. It peaked out, it came down very nicely. And then at the end of July, which is where our market peaked for this year, it started to come back up because oil prices were coming up, right? And so the market dropped 10% in the same time frame that this thing was going up. So if you really want to pay attention to what's happening to the market, you probably need to pay attention on what's happening to this overall inflation, and certainly oil is one big area, right? Because that's what scares people. If we look at core inflation on the CPI, where they take out oil and food, kind of more volatile aspects, this is what the Fed tends to look at more. You can see the trend is pretty nice. It just continues to come down. That's exactly what we want. But again, I don't know that the Fed is looking at core. As an investor, you might be wanting to look at this top line inflation, because this is relating to me more to what's happening in the market. As that started to come down, we've seen this big 3-week jump. As that it started to come up, we saw a big 3-month slump. So definitely interesting as far as that goes. And this is kind of neat. This is sort of, I know you can't see this very well, but if you just look at these colors, these are the segments that the CPI is broken down into. If you pause this and probably zoom in, actually, maybe change the view here so we can see it a little bit better. That's better. What this is showing is red means that that particular segment category that CPI is looking at is actually up. The more red, the more it's up. And of course, the more green, the more it's down, right? And if you just look, and this goes back in time, so I'm on the side of the more current time, and Easton's on the side of the more, in the past, November of 2022. It's pretty obvious. I mean, look how many oranges and reds there were, a year ago, 6 months ago, versus how many greens and yellows there are now, right? And so it's kind of across the board. And then again, if you want to study this, you can see the weightings, right, of what really matters. What shelter as a whole is 34.9%. Yeah. And that's where, if you spend some time looking at that, that's the part that's had the hardest time kind of coming down. Or slowing down.
Like, even if you look at it now, it's at 0.33%.
Right.
So it's still maintaining it versus what compared to the rest of the market.
Yeah, and of course CPI is famous for its kind of strange way of looking at shelter from an inflation standpoint, because they have it right here, owner's equivalent rent of residences. So they basically try to determine, what you would pay in rent if you were renting your place instead of owning it. And they do it on a sampling basis. They rotate through different places. It's kind of interesting. And it's one of the reasons why the Fed actually doesn't like the CPI as much as PCE. PCE has, I think, a more robust look at, inflation as a whole. But it's still kind of fascinating. I know that costs are still going up, but they're going up at a slower pace than they were. and this rate increase and that big jump we saw in rate increases, from 2008 to now, this is the impact of that, and it's working, right, at this point. Now, what you want to see is slowing down, but not slowing down too much,
Yeah.
right? And so that's the soft landing. That's what we're getting so far. Doesn't mean we'll stay there. That's the big question, and that's what people are worried about. So we'll see how that goes. But altogether, things are really good right now. Let's hope it continues, and we'll, kind of, be happy when things are going well. That's for sure. All right. So that was our summary for the week. Thank you for joining us, and really, look forward to being able to talk to you. The next week we will not have a show because it's Black Friday. We're trying to figure out what's going to happen the week after that at this point, but appreciate your time. Thank you.
So what can we expect from the market if the Fed puts a hold on rate hikes?
Yeah. Okay. So it's always a little bit hard to tell when they're putting a hold on. It's easy in hindsight.
Yeah.
Because you can go back and say, oh yeah, that was the last rate increase, and so how much did it gain or lose after that? But now that we're living it in real life here, one of the things that's happening, of course, the rhetoric hasn't changed. We're going to raise rates. We're going to raise rates. We're going to hold them higher for longer, all these things. And now they have a vested interest in trying to, use that rhetoric to slow down the growth on assets and to make things more expensive. They love the bond market falling apart to a certain degree because it makes higher rates that people will have to borrow at. The stock market going down, not a bad thing in this case either, because that slows down people's propensity to buy, all those things. So, but historically, and we actually have a chart for this too, put this up. Historically, it's been really good.
Yeah.
S&P, this is, from Forbes, S&P goes boom after Fed pauses. So if you look going back to 84, 9, 22, 19, -6. If you go all the way across, actually, you can see 2000 was definitely an exception to the rule here. It was not a good, didn't do well after, but it did well after all the other ones. The average rate of return just after 6 months was 12.5%. Again, 12-month return average on the S&Ps are just about 11%. So 12.5 in 6 months is way above average. 16.7 in 12 months, 46% in 3 years, and 70% in 5 years. So the market really, really likes once the Fed gets done with its rate increase, regime. And so, and these are fairly long look forward in the end at 70%. I mean, amazing, 109%, doubled, in 84, 199. Again, 2000 was down, last 2006, et cetera. So you've got a scenario here where once the Fed stops raising rates, the market goes up. And I think that's what we're seeing in this last 3 weeks is more and more conviction that they might be done raising rates, right? And we're seeing that in that CME Fed Watch tool, which is the look at the futures market for guessing what the Fed's going to do. Right now, it has no rate increases at all. It's done. Possible rate decrease by May.
Yeah,
right?
A lot of people are predicting decreases in the next year.
Yes, yeah, exactly. My concern is why are they lowering rates? And so, because sometimes it's fine, just in the sense that, hey, we're lowering rates because, things are starting to slow down a little bit. Sometimes it's because something broke. And then it becomes an issue for the market. So, we'll have to find out how this works. I'm of the belief right now that when things break, the government lately, maybe since 2008, has been stepping in and fixing it with money.
Yeah.
That's not what happened before 2008.
Yeah, you can look at March when the Silicon Valley Bank,
Yep.
There's the run on Silicon Valley Bank and how much the government stepped up there.
Yep, because that was our Lehman moment, in my opinion. And when Lehman was allowed to fail, we dropped roughly 30% on the S&P 500, very quickly after that. And maybe that would have happened this time too if they just let Silicon Valley Bank fold, because that would have been many regional banks folding.
Yeah.
Because there was almost 5 or 6 anyway, even with the support. As a matter of fact, they were absorbed by other banks. And but because they stood up and put that money forward, and in a political environment heading into a presidential election year, they don't want to let what happened in 2008 happen again. So I think it's going to be interesting. The other thing that's factoring into this, besides just this Fed pause, election years are quite good. They're 3 out of 4. The market's up. That's a high probability event also. So, we got a lot of things that are, I think, tailwinds for us that could help out with this market right now. And, you know, I'm a little concerned that inflation could start to pop back up again because we do have a pretty healthy consumer. But we are seeing some softness in retail sales, which again is normally bad. In an environment where you're trying to get to a soft landing, it is the retail sales that are kind of keeping that inflation up
Yeah.
higher. So softening that a little bit, and we're seeing some of that. And again, that's why the market's moving so well.
Yeah, and similarly, you're seeing some softness in the jobs too.
Yes, yeah, nothing dramatic. And again, the weird part is there's kind of this Goldilocks zone that we're shooting for, right? I mean,
Hmm.
there's not this dramatic, big drop in jobs, which would help inflation, but would also probably signal, coming recession or contribute to one. So small deteriorations in certain areas, we saw it in factory production and what have you early in the year, and those types of things where there's just kind of a slowdown because things are too hot. Money was too easy to get to, and people are spending it like mad, and just enough spending to keep us from a hard landing.
What does it mean when small cap stocks run? This week, the Russell's up almost 6% versus the S&P's, which is around 3% for the week.
Yeah, so the Russell 2000 is an index of 2,000 small-ish stocks, and it's been kind of lagging in comparison to the S&P 500.
Hmm.
So there's been quite a few articles talking about. As a matter of fact, I think Bank of America this week came out and said that they were recommending an overweight in small caps, and we certainly have seen a big jump in those. I do have a chart on this also. Uh, so the gold line here is the S&P 500, really since the peak
Yeah.
last year. The green line is the Russell 2000. You can see they match each other overall to a large degree. When there's big bumps, they both have big bumps. But the difference is the rate of return is pretty substantial. It was positive in this case 3.7% versus negative 19.6. So you know that adds up.
Yeah, you can see in 2023 how the S&P broke above its, or it started to have higher highs, but the Russell still hasn't done that. Their
Yeah,
last peak wasn't higher than their previous high.
yeah, and so I would look at that and say that we had a major downtrend at the beginning. Every high was lower, and then now we're really trading sideways, right? I mean, if you look, it's just a sideways channel. The highs are touching at the same place, give or take. The lows are touching at a very similar, if not same place, really since last June. And June of 2022 for that matter,
Yeah.
right? So it's in a trading range. And so when it gets to the bottom of the trading range, as you can see, it's had a really nice run here. Still more volatile and what have you. But the thing that's important about small cap is that it isn't the first thing that leads you out of these, recoveries because it's a riskier asset and people need to get into a more comfortable position with where things are before they start to move. You want to watch small caps because it tells you it's like a heartbeat on risk.
Hmm.
And so when you start to see small cap run, you start to see a scenario where people are feeling more comfortable.
Yeah, and that's good for the market in the broad sense.
That's right, all the way across. And so, is it something that I would do based on looking at this chart? Yeah, we own pretty much everything as much as we can. We use these very broad indexes for a majority of our stock market holdings, and they include small caps as well as mid caps and large caps, and
Hmm.
they're generally market cap weighted, which means small caps don't have as much impact as the bigger stocks. So you always want to have that spread in terms of our targets, where we're really looking for what's moving right now. We are not in small caps yet. We need to see some more proof. We're not early buyers. We're not trying to catch a falling knife. But I do think that this move is important. I would not be surprised to see it continue. The only problem we've had with small caps is they've made so many false moves on this chart. If you look
Hmm.
closely, lots of great run-ups, and these are fairly big percentages in a lot of
Yep.
cases, followed by a collapse back down to kind of that bottom. So if you're going to do this at the moment, I would assume until otherwise proven that we're in a channel, a sideways moving channel, we're fairly low on that channel. You could buy now and get to the top of that channel theoretically, and you can still make some money, but you probably don't want to buy anywhere near the top of this channel, right? Which might be a couple months from now if it keeps going, because until it breaks out of that channel, okay, good. Now we're off and running, and maybe we've got another scenario. But what you will see normally is small caps run at the end of a scenario. So when you look at a chart of say 2020, 2021, small caps were running really hard in that scenario. It's because people are looking for more. They're totally confident and they want more money and more returns, and they're moving more into higher risk arenas because they generally will return more in an upward moving market. Now they tend to give a lot back if you're not careful, on the downside, which is what happened to small caps in 2022. But yeah, no, I think there's some play here. I'm excited to see that it's running, and I think that this is an important component of what's happening here. So yeah, I wouldn't give up on my large cap stuff, but adding some small cap is not a bad scenario here if you don't have any.
Yeah, because if you think about small cap year to date is up about 3% versus the S&P is about 17%.
Yeah, it's in a way you look at that and think, okay, if the market is up, it's going to rise. A rising tide, floats all boats, type of thing. And so that's what Bank of America's article was talking about. Is like, look, this is needs to catch up, and in that catch up, you could make some money. I don't have a real big problem with that. It's a little bit early to tell whether this, really has legs. I feel like it has legs. The power of what we're seeing right now in the last 3 weeks is pretty important. Momentum is very strong to the upside here, at least in the short term. And so, inflation's getting better. Oil is, lower than it was, although today it's making a little run. But nonetheless, I think that, it's something to look at. We're just not there yet. We already have exposure to small cap through our broad, indexes, and I feel comfortable with that as far as that goes.
What is the no landing scenario? We've talked about soft and hard landings, but what about the no landing?
Yeah, I think if you know what a hard landing is, a recession, right? By definition, and maybe a hard recession, a bad one, which is what everybody was predicting last year for this year. It didn't happen at all. And so a soft landing would be maybe a recession, but you didn't even know it until they told you, right?
Yeah, it was kind of just a general slowdown, not very rough, not a lot of job loss, kind of just a general slowdown of the economy.
And a no landing just means nothing happens. It just keeps going. And basically that's what's happened so far. I mean, if you really look at within realm of standards, employment has been great altogether. Job openings still are persistently high. The economy, we just had a 4.9% GDP growth for the last quarter. We'll see if that gets revised. They tend to revise these things, but still pretty surprisingly high as far as that goes. So again, my premise is that the Wall Street as a whole saw a massive increase in interest rates, and historically that means hard landing, period. Matter of fact, one of the weird things is we're seeing that across corporate America. For the last 2 years, they've been preparing for a hard landing.
Yeah.
And what's happened is that they've got more efficient and cut back on costs and saved money, and now their earnings are coming through really very nicely. I mean, Target's a great example. They were kind of struggling. They had the wrong kind of inventory for a while, and they're getting ready for this coming recession. It hasn't happened yet. Maybe it will, but they're getting ready. As they got ready for it, they got more and more efficient, and their numbers are looking surprisingly better, because they responded. It took a while, like a year, but they had an 18% run-up day. I don't know what it ended up in the end, but something like that after the announcement of their earnings, and they did quite well. So, I think this is one of the things that's actually benefiting us all in terms of this market recovery. But a no landing scenario is less likely than soft or hard, but who knows? The problem is, and again, finishing my premise is that this pandemic has caused a scenario that you can't really look back on historical data and draw the same conclusions. You can't look at the 70s and 80s and that high inflationary period and draw the same conclusions, because there was no pandemic. There was no free money scenario with trillions of dollars pushed out by governments. There was no pent-up demand for people that want to go do things, live life, after being locked up for a long period of time. And
Yeah.
so that has offset the higher interest rates. People are borrowing on their credit cards if they have to do what they need to do. And so it's a different scenario. You have to pay attention to that difference to kind of understand what's going on. All right.
What can we expect from next week with a short holiday week in the market? Thursday the market's closed. Friday is a half trading day. So what can we expect from a shorter week?
Yeah. Well, one thing, Martin Zweig, who's a kind of famous investor, has written several great books, and he had a whole section in there about Black Friday. And he pointed out that 3 out of 4 Black Fridays, the market's up. And so, from a trading standpoint, these guys are looking for small edges, and they look for these anomalies and what have you. So, Black Friday is normally up. For whatever reason, half a day, thin volume, people are excited about the haul. I don't know what it is, but now last Black Friday the market was down, so maybe that increases the probability. I don't know, but last Black Friday came right after the Federal Reserve, literally on Thanksgiving week, started aggressively talking about going after higher interest rates because inflation,
Yeah.
was happening, and the market peaked very shortly thereafter, got very volatile in that time frame. And so that's not true this time. We're having kind of the opposite expectations for no interest rates, inflation's falling, those things that were causing that problem. So it'll be interesting to see what happens Black Friday. We don't trade that way, but, just to answer the question, the volume's light. That doesn't mean that the price doesn't move, right?
Yeah.
And
It makes it easier to move the price rapidly though
that's right.
with lighter volume.
A smaller number of investors can have a bigger impact. And so, who comes to play? In my opinion, is it the retail investors? Because they have been optimistic all the way through. Since 2020. They are buyers. They're coming in and buying. Or are the institutional investors, taking this is their job? This isn't just some fun thing they're doing on the side. Do they take time off? And we get a run out of the smaller investors who are the only ones left,
Yeah.
and they can drive the market, especially using their options. So we'll see what happens. I will be doing the daily video on Monday, Tuesday, not Wednesday or Friday. So we'll talk about what's happening at that time. There isn't a tremendous amount of news coming out either.
No, it's a
Government
pretty
institutions.
slow week for the
Yeah,
economy.
yeah, it's a good
news.
week to kind of kick back and see what happens. But I think it's only enhanced a little bit in terms of interest because of this massive run that we've had with no real downturn at all. It's slowed just barely here and there a couple of days. So it's very, very powerful. And does that continue through this thinly traded week and into December? December's historically a good month, a decent month. Although at the very end of the year, it will be the end of the quarter, and we get this big rebalancing that happens. And last year, I think it ended on the 27th, 28th. There was a pretty big downturn.
It might be interesting though because bonds and stocks have been going up.
Yeah, because the rebalancing, it could have less impact if they both had some, similar returns. Then you're not going to rebalance. What we're talking about is these big target date funds that have targets for certain categories, and so they rebalance those back. So if the bond portion is smaller, they'll be buying bonds. If the stock portion is smaller, they'll be buying stocks. So you kind of look at what's happening, leading into that. But last year they were selling a lot of stock because the bond market had done so poorly, and we saw a big drop off, only to turn around in January of this year and really rip. I mean, it was awesome. Anyway, that's kind of what's probably looking past just Thanksgiving. Some of the things that we're facing here for the end of the year. All right.
What are your thoughts on buying points versus a larger down payment for a mortgage? Interest rates are, they've come down a little bit, but they're still, vastly higher than a few years ago.
So buying points just means that, you can buy, maybe I can get 4.5 with paying some points.
Yeah, and there's always some sort of limitation because they're not
Right.
going to let you go super below the interest
No,
rates.
no, that's right. And then you would have some payback period because, hey, I paid X amount for these points, but I'm having to pay 4.5 instead of 5. I'm making these numbers up, but I'm going to get, if I look at that and calculate that out, I'm going to pay myself back for that extra points in 18 months or 5 years or whatever it is.
There's a break-even point
Right.
where, you come out ahead, but it takes some time.
Right. So the question is, should I pay the money to buy down the interest rate or not? Right? That's basically what it comes down to. So when we look at that, to me, there's a couple things. Number one, where are rates relative to historical standards? And so when rates were at 2.5%, 3% on the mortgages, that's really low.
Yeah.
No ifs, ands, or buts. I might pay points on that lower one to lower it even more, because my fear of paying points is that I'm going to refinance this and not get my payback.
Yeah.
Right?
Because if you say you start at 7%, but you buy down 0.5%, 6.5, but your payback period is 3 years.
Right.
But interest rates drop to 5% 2 years from now. You're not going to stay at that 6.5% if you can get 5% by refinancing.
Right.
So you then lost out on that kind of buying those points.
Yeah, you lost money essentially, right? I mean, you paid more than you didn't get through your break-even period because it was 36 months, and 24 months later the rates. So if rates are higher, like maybe now, I mean, there's been a pretty good stretch here. You look at the Fed Watch tool, it's expecting the Fed to lower rates next year. Whether they do or not, we'll see. You look at the Fed dot plot, what they put out every 4 times a year, where they're projecting, what rates are going to be. They're projecting lower rates next year also. Yeah. So if you're getting an 8% mortgage right now, I wouldn't pay points.
I'd just try and put extra money to the down payment.
That's right. If I had that extra money, I'd put it into the down payment so I don't have to pay 8% on my money. I can put it in there and basically make 8% in a way, not quite accurate, but nonetheless. So that, I think that's a big factor, is like, where are rates now, and how does that relate to, history? Do I feel I'm going to have to get a chance possibly to refinance within my payback period on those points? So I paid points, got a 2.75% mortgage at the very end of 2021. And I'm very happy with that. It was 3, and I paid it down, and my payback period is, I don't see that being refinanced.
Yeah.
Below 2.75%. If I had an 8% mortgage, I would not pay points. I think I could probably wait and see.
Yeah, and I think that's what a lot of people are feeling, is that let's not buy points, let's just wait it out, kind of refinance at a later date.
Yeah, I think it's an interesting calculation. There's an element of math there, and to figure out payback period. There's also an element of understanding what's going on in the markets, and so that's what this show's about, is to kind of like educate people on how to make some of these decisions, or even and what to ask. Ask this of your advisors, and have them figure it out. So the premise that I would be operating under right now is that rates are probably going to go lower. If I'm locking in an 8% now, it might be temporary. I might be able to get 7 or 6 or 5 at some point in the future and ratchet that back down. And then once you get low enough, like I'll probably never be able to refinance my mortgage at that rate, right? So yeah, that's okay. It just keeps going. It is one of the things that's holding back housing and keeping the price up. A lot of people have these low mortgage rates, and if they want to move and capture a new mortgage, all of a sudden they're going to go from that 3 to 7 or whatever.
Yeah.
And so people are deciding to stay, and there's still people wanting to buy, and that's why the housing market miraculously is holding up, even though rates went from 3% mortgage to 8.
Yeah.
The market is still hanging in there. It's incredible. But that's part of the reason. Just people aren't willing to sell. So. Well, great show today. I want to thank everybody so much for the questions. These are great questions. Love going through this. This is great mental exercise for us. Send in your questions so we can answer them at the next show. Again, we won't be here next Friday. It's Black Friday. Might not be here the Friday after, kind of trying to figure out one little thing that might be in the way, but certainly we'll be back after that. Send in your questions so we can work on them and answer them for you. Put them on the video, put them on the channel. You can refer to them at some point in the future. And love to answer them. So thank you very much for coming today, and look forward to seeing you in a couple of weeks, maybe 3 weeks. We'll see what happens. Okay, thank you very much.